financial accounting, statement of cash flows. Let's do a full statement of cash flows. Step 1, find the answer. The answer in the statement of cash flows is what's the change in cash. So in exercise 11, if I look on my balance sheet at cash, I can see at the beginning of the year I started at $12,500 and I ended the year at $69,900. So how much did cash change? Cash went up $57,400. So when I analyze for operations, investing, and financing, I know it's going to come to a change, an increase in cash of $57,400. So I know where I'm going. Step 2, do operations. Operations, remember, we start with the bottom line. So I look at my income statement and I see that I had a net income of $17,900. And if I had a net income of $17,900, I am in operations going to change that net income into cash from operations. So not what were my profits, but how much money, honey, did staying in business on a day-to-day basis yield me. So the next thing I do is I cruise through my income statement looking for depreciation expense and any other non-cash expense, because those I'm going to add back. And it says that depreciation was $19,300. Well, depreciation made net income smaller because I deducted it, but didn't take any cash out of my pocket, so I'm going to add it back. I will also look for any gains, which I would subtract, or any losses, which I would add back. There aren't any. Now I go to current assets on the balance sheet. And the first current asset I see, besides cash, is accounts receivable. And accounts receivable decreased. Well, what was the change? Accounts receivable went from $26,000 to $21,000. So accounts receivable decreased $5,000. Now the only way receivables would decrease is if your customers paid you. That means cash flowed in, added. Next current asset I see is inventory. Inventory also decreased $5,000. The only way inventory decreases is if the customers bought the inventory, which means you got cash. So add it. The next current asset I see is prepaid. Now prepaid expenses started the year at $2,600, ended the year at $3,200. So did prepaid go up? Which means you must have gone out and bought some like prepaid insurance. And if you go out and buy prepaid insurance, what happens to your cash? You're right, it goes down. So if a current asset goes up, we're going to subtract the change, which is $600. Now we turn our sights on current liabilities. The first current liability I see is accounts payable. And accounts payable started the year at $14,000, ended the year at $13,000. So accounts payable decreased $1,000. Well, the only way your bills go down is if you pay them. So if current liability decreases, that means cash flowed out. The last current liability I see has to do with income tax payable. And notice income taxes payable started the year at $1,800, ended the year at $1,200. So taxes decreased $600. Well, what's the only way your taxes go down? Oh, you're right, you paid them. So that's a cash outflow. So if I look now and I add and subtract accordingly, all my changes in my current assets, my current liabilities, my depreciation, any gains or losses, notice the cash flow from operations is $45,000. So I may have had a net income of $17,900, but notice the cash, the blood of business, was $45,000 instead. So that's the operating section of exercise 11. In the next tape, I'm going to take up and explain investing and financing.